So, if you're a homeowner, I bet this question has crossed your mind at least once. Is it time to refinance? I mean, with interest rates always on the move, it's one of the biggest financial decisions you can make. So, today, let's break it down and try to figure out the answer together. Because this is really the big question, right? Nobody wants to feel like they're overpaying month after month, just leaving money on the table. In this explainer, we're going to give you the tools you need to answer that question for yourself with confidence. All right, first things first. Before we get into the pros and cons, let's build a solid foundation. What are we even talking about when we say refinancing? Okay, so this is the number one thing you've got to understand. Refinancing is not just tweaking your current loan. It is a complete and total replacement. You are literally taking out a brand new mortgage to pay off your old one. That means a new application, new paperwork, the whole shebang, just like the first time around. And this is a great way to think about it. It's really just a big swap. You're trading in your old loan with its interest rate and its payment for a completely new loan. And hopefully that new loan comes with a better deal, a lower rate, a more manageable payment, or maybe a different term that just fits your life better now. So that begs the question, why would anybody go through all that trouble? What are the actual reasons, the real motivations that push people to refinance? Well, there are a handful of really big ones. The most common, the one you hear about all the time, is just snagging a lower interest rate to save money. But some people want to pay their house off faster, so they'll refinance to a shorter loan. Others just want peace of mind, so they'll switch from a risky adjustable rate loan to a stable fixed rate. And then, of course, there are folks who need cash, either by lowering their payment or by pulling out some of their home's equity. And really, all those reasons kind of boil down to two main flavors of refinancing. On one side, you've got your standard rate and term refi. That's simple. You're just swapping your loan for a new one with better terms. But on the other side, you've got a cash out refi. And that's where you borrow more than you currently owe on the house, and the lender gives you the difference in cash. People use that money from everything from home renovations to paying off other debt. Okay, so we've got the what and the why covered. Now let's dive into the how. What does this whole journey actually look like? Let's walk through the blueprint, step by step. Now, if you're looking at this list and thinking, hey, this sounds familiar, you're exactly right. It's pretty much the same dance you did when you first bought your house. You'll gather up all your financial docs, you'll apply, then the lender's team does their thing with processing and underwriting, and finally, you get to the closing table. That's when the old loan gets paid off and your new one officially kicks in. And listen, you're not going through this maze all by yourself. There's a whole team of people working behind the scenes. You've got the processor, who's like your paperwork quarterback, the underwriter who gives the final thumbs up or thumbs down, an appraiser comes out to figure out what your home is worth today, and a title company makes sure everything is legally good to go. It's a whole coordinated effort. All right, so far so good, right? But refinancing isn't free. Not by a long shot. And it is absolutely crucial that you go into this with your eyes wide open about the real costs. So let's have a little reality check. As a general rule of thumb, you can expect your closing costs to be somewhere in the ballpark of 3 to 6% of whatever you still owe on your loan. So to put that in perspective, on a $200,000 loan, you could be looking at anywhere from $6,000 to $12,000 in fees. It's a serious chunk of change. So where does all that money go? Well, it's a lot of little things that add up. You've got your application fee, the appraisal fee, fees for the title search, and then there's the big one, the loan origination fee. That's basically what the lender charges you just for creating the loan. All these things pile up, and you need to know what they are. And this, right here, is probably the most overlooked part of refinancing. Because you're starting a brand new loan, you are completely resetting the clock on paying off your mortgage. You're going all the way back to square one, where your payments are almost entirely interest and you're barely touching the principal. You're restarting that long, long journey of building equity from the beginning. Okay, now that we've got the process and the costs down, let's talk about the traps, the big mistakes people make that you are definitely going to avoid after watching this. This is the classic mistake. A lower monthly payment feels like a huge win, and sometimes it is. But if you get that lower payment by stretching your loan term way back out, say you only had 20 years left and you go back to a 30-year loan, you could end up paying way more in total interest in the long run. Seriously, your credit score is everything here. It's the main thing lenders look at to decide what interest rate you deserve. So before you even think about applying, pull your credit report. Look for errors. Cleaning up even one little mistake could boost your score and save you thousands and thousands of dollars. This is a big one. You wouldn't buy the first car you see without looking at others, right? Same thing here. Don't just automatically go with your current bank or the first offer that lands in your mailbox. You have to shop around. Compare offers from different lenders. Look at the rates, the fees, the terms. Find the best total deal for you. This is some simple but super important math. You have to calculate your break-even point. That's just how long it will take for the money you're saving each month to add up and cover your closing costs. So if your closing costs are $4,000 and you're saving $200 a month, your break-even point is 20 months. Easy as that.
And that break-even point calculation is totally useless if you don't know how long you're going to be in the house. If your break-even is, say, 3 years, but you think you might sell the house in 2, well, you'll have lost money on the deal. You've got to make sure you'll be there long enough to actually enjoy the savings.
And that really brings us full circle to the most important question of all. It's easy to find out if you can refinance. A lender will tell you that. The much harder and much more important question is, should you? And that answer depends entirely on your goals, your plans, and a really honest look at the numbers. The real power is in asking the right question.